What's up everyone, my name is Bowie, and in today's quick video I'm going to explain you what breaker blocks are and how you can use it in your advantage. Let's get straight into it. So what is a breaker block? Well, as always, we have two types. We have a bullish breaker block and a bearish breaker block. Let's first start with the bearish example. This is what you want to see with a bearish breaker block. I'm going to first draw it out and then explain to you guys. So what happens is something like this. And how this actually works is, if you see at this piece of price action right here, you see the price makes a higher high followed by a higher low and another higher high, which breaks this structure right here. So if you look at this piece of price action right here, you'll notice that we are in a kind of bullish market structure, right? Because we're constantly making higher highs with higher lows, higher highs. But what usually happens then afterwards with bearish breaker blocks is that, let's say I'm a typical supply and demand trader, so I draw my demand zone right here because I expect that price afterwards touching this demand zone, it will go up, right? Because we're in a bullish market structure. But what happens with bearish breaker blocks is that price doesn't respect this demand zone right here. It just breaks through it like with a lot of momentum. So basically this higher high, you see that it's not a very strong one. This was basically grab of liquidity. It was not market structure developing itself to the upside. It was just a liquidity grab before the shift in market structure, before this break of this demand zone. So if you would enter a long position right here, then you would have been stopped out because price breaks through this demand zone with a lot of momentum. This is a demand zone and it just breaks through it with a lot of momentum, and then this demand zone turns into a breaker block. So this demand zone turns into a breaker block and retests this demand zone, which is now a breaker block, before continuing the bearish market structure. So recap, price makes a higher high, then a higher low, then price makes another higher high, but a very weak one. You don't want to see price making a very strong higher high, because then you don't want to anticipate on a possible bearish breaker block. So what you want to see is a very weak break of structure. This line is the break of structure, and then you want to see a very aggressive move towards the downside. Basically price ignores this demand zone and breaks through it with a lot of momentum, and that is where you want to anticipate on a possible short right here once price retests this demand zone, which is now turned into a breaker block. And does that mean that if you see this happening on your chart, that you immediately want to place your orders with your entry at this breaker block right here, your stop loss above it, and your take profit targeting previous demand zones? No, please don't do it. You don't want to enter just because you see this bearish breaker block. You want to see way more. For example, if there's also this big move right here, it probably caused also an imbalance. So you want to see an imbalance here too at the same area of the breaker block. You also want to see EMA confluence, MA confluence, Fibonacci retracements, whatever you use for confluences. So you need a lot of confluence in the same area before entering your trade. So don't just blindly follow this strategy, of course, but this can be a very good confirmation for entering your trade. And then let's say that you found a lot of confluences. Let's say there's an AMA right here, fair value gap, previous support turns into resistance. Then whatever confluences you found, you want to place your entry just below it, right? Because you don't want to get front run on this trade, and you want to place your stop loss just above your found confluence, above your levels of resistance. And then the other way around, I'm just gonna invert the chart, and it's actually the same but just the opposite, of course. So what you want to see with a bullish breaker block is let me just quickly put this here. What you want to see is price making a lower low followed by a lower high, so followed by another lower low, but you see that this lower low is not that strong. If this lower low was like this, then you don't want to anticipate on a possible bullish breaker block. You want to see a very weak break of structure. So this is the break of structure, but you want to see a very weak one, because this can be potentially just a liquidity grab before breaking this high right here, so it shifts market structure, and this, it was a supply zone, of course. This supply zone then turns into a, in this case, a bullish breaker block. So what you want to see is recap, lower low, lower high, break of structure, a very weak one, then a lot of momentum breaking this lower high, and then so it basically forgets this supply zone, but then it retests the supply zone, which is now turned into a bullish breaker block. And so you want to enter around here, but of course you don't want to enter just because you see this. You want to see way more other confluences, and then you want to put your stop loss just below those confluences. So if I'm gonna long right here, I'm gonna put my stop loss below all the levels of support I found, and my entry just above the confluences, so I don't get front run on my trade. And then for my take profit, I'm gonna target possible sell side liquidity or other supply zones. So this is basically how these breaker blocks work. And then before you go, I want to give you one last example on the actual chart. So what you see right here is a low with a higher high, a higher low, another higher high. But notice that this higher high, this break of structure, is not a very strong one. This is considered a weak break of structure, because if I saw something like this, then I know that, okay, we are still in a bullish market structure. But if this higher high is not that high as you want it to be, then this could be potentially just a liquidity grab, and this consolidation could be seen as a form of distribution. So what happens is the theory of breaker blocks. This is basically a liquidity grab. Then demand, supply and demand traders would draw their demand zone right here. This is my demand zone, and then they expect that price will touch this before going to the moon again. But it's not gonna happen for them, because price breaks this. Look at this candle. I'm gonna zoom in a little bit. Look at this big candle. It just doesn't respect this demand zone. So what happens afterwards is that price touches this demand zone, which is now a breaker block, a bearish breaker block, before moving back down. You see? So what you want to see on the live markets for a bearish breaker block is a higher high, a higher low, a weak higher high, which is basically a liquidity grab, then a very strong move that breaks this demand zone. And because it breaks this demand zone, it turns it into a bearish order block, which you can use to then enter a short right here. But again, don't just short because you see this. You want to see other confluences, like in this case buy side liquidity, EMAs, Fibonacci levels, whatever you use. And then this could be potentially an amazing short in this example. So this is an example of a bearish breaker block. I hope you learned something. If so, don't forget to like, subscribe, and hit the bell. I hope you have an amazing day, and I'll see you in the next one.